hear it.
Now New York is right.
I want to hear it.
Okay.
The stock market, folks, has hit all-time highs 40 times in 2017 alone. But when it comes to investing, many African Americans are not in the game. 35% less likely than whites of similar means to invest in the stock market. So the question is it something for you? Joining us right now for our WealthyU segment is Deborah Owens. All right, so let's set this up. First of all, every time you see Trump, he thinks that his election by itself just somehow totally changed the stock market. The stock market, when it was low as all get out in 2009, when after we were under President George W. Bush, I ain't gonna say Republican because I don't want Brandon to start whining. Oh, wow. We were losing 500,000 jobs a month. Then of course, stock market just tanked. And since, let's say, I would say late 2009, 2010, it has been on a steady increase. So first of all, explain how is it that the rest of the country feels as if things are not getting better or progressively getting better, but the stock market, look, it's just been sky high. What's going on here?
So that disconnect, that's a great question, Roland.
That's what I do here.
I don't know.
So let me,
I'm surprised.
Whether you a visitor come like today, I think I do here.
That's a great question. It is true. The reason why people are not feeling it in their own pocketbooks or wallets is because what we haven't seen is any wage growth, right? And the fact is, even though the stock market is up, what I can show you is that if we look at home prices, they still have not recovered back to pre-crash levels, right? And so
overall, some places they have.
Some places, yeah. But I mean, if you look at D.C., if you look at San Francisco, if you look at some pockets, but overall, you know, even I'm in Maryland, in one of the most highest income areas in Maryland, in Howard County, and if I were to look at my own home prices, what I will see is I'm probably, I didn't go down a lot, but I'm just about even. But a lot of people are still underwater. They can't refinance. They went through loan modifications. So that's why they're not feeling it, coupled with the fact that if we look at African Americans, speaking directly to this study and these statistics, a lot of African Americans came out of the market, went to what were so-called safe investments in these fixed accounts. If you're in a government plan, it would be considered the G fund. And so they sat out of the market. And what we've seen is those plans have barely done 2%. Whereas if we look at the historical return of the stock market, the S&P 500, what we've seen is 10% annual average return. So 2%. 10%. That's why people are feeling this disconnect and don't really feel like they've been able to participate in what has been a pretty significant rise in this market.
But you made the point earlier when you talked about wages not growing, and I think what people have to also understand that what's been going on. These companies have been hoarding cash.
They are. They're sitting.
And what they're doing is they first of all, productivity did not drop, and so what they said is, wait a minute, if I'm still making money and I got fewer workers, productivity is still high, I'm good. And so they literally are sitting on so much cash, and so the folks who are investing in these companies, I mean, that's a very small percentage of the American population that's benefiting financially, where the rest of the folks saying, hell, no wages. The reason you guys are doing so great with stock market.
Yeah, and you know, one of the things that people need to understand is that one of the ways that companies meet those quarterly earnings is by keeping, you know, probably the knee-jerk reaction is, you know, to do a layoff. And now you look at the gig economy coming in. And so I just looked at a stat, 1 out of 3 millennials is freelancing, right? And so if you look at when you came out of college or when I came out of college, we came out, I mean, I was earning what millennials are earning now. You know, my son came out in 2009 earning $35K. Well, I was earning that, you know, 25 years ago. And so that is the issue, is that wages are not increasing, expenses continue to get higher, so people really don't feel like, you know, they're being impacted, or they're not seeing this this boom that we're seeing, that the stock market numbers are telling us.
So somebody's sitting at home and they're saying, okay, we got the stock market and I'm seeing this sky high. I mean, am I losing out? Is it too late for me to get in? Because when I go back to, I mean, several years ago, you were saying on here, do not pull your money out. Trust me, when this thing turns around, you're going to be happy. But people got spooked and they said, oh my God, my mutual fund went down. Okay, take my money out.
Great point. And so what is really, really important is that you take calculated risks, Roland. And the way you do that is you have different eggs in different baskets. We are going to have a correction. I mean, we can't continue at the levels that we have. If you look at stock prices overall, many of these prices are inflated if we were to look at historical earnings. I'm not going to get too technical, but the point is that a couple of things, that at no time should you ever have all your money in stocks, right? And depending upon what your goal is for your money, that's going to tell you whether or not you can take more risk. So people sitting, listening to this program right now, as it relates to what should you be doing, first thing is take a look at your portfolio now. If you have been in stocks, what you're going to see is you got a greater percentage in them now because the market has went up. The other thing is if you're sitting on the sidelines, and that's really what I wanted to talk about today, you know, how do you ease in? Yeah, I'm listening to you, Deborah Owens, but as soon as I go in, what's going to happen? The market's going to go down. So I feel like you got to be in it. You can't be afraid to lose, right? So you got to be able to, you got to be in it. And so one of the things I suggest people do is just set up a model portfolio. Like you can go to investment sites like finance.yahoo.com and NASDAQ.com, and you can start fooling around with either mutual funds or stocks and put together as if you've set up a portfolio of $100,000. So you can get accustomed to the market going up and down. The other thing I would suggest, and that I think is really, really an opportunity for people is, you know, back in the day when I started, you needed $10,000 just to invest in a mutual fund. Whereas now you can start with apps like Robinhood.com, Acorns.com, which will allow you to invest with start as little as $10 or so. And that's really how you win the game. It's not trying to time the market or go in at the right time. And then lastly, my suggestion for most people who've had no exposure in the market, what they can do is invest in what is kind of like the most conservative type of mutual fund you can invest in, and that is an index fund based on the S&P 500. And basically that'll allow your money to go up and down, but you've got a lot of diversification because you're invested in all these different companies.
So I'm enjoying this ride of the stock market right now. My 401k is doing great, and I live in the district, so I'm one of the people who bought at the right time, and now my house is worth a lot of money. But one of the issues I wanted to talk about and to expand upon is, you know, also taking that risk, and then as the market has boomed, as we've seen, it's doing wonderfully, how do we mitigate that risk if it were to go down? I mean, it just keeps going up and up and up and up, and at some point it's got to correct.
Oh, yeah.
Right, and so that, to my point, what people need to be doing is taking a look at their portfolios now and seeing how much do I have in stocks, right? So typically, you know, one of the rules of thumbs I use is to take your age, subtract it from 100 or 110, and that percentage of your investment should be in stocks. So right now, if you've seen the market, you've probably seen your portfolio grow by 20 or 30% in the past 5 years. You need to be moving some of that money into conservative bond portfolios or intermediate bond portfolios so that you have that mix, so that eventually when the market goes down, and it is going to correct, your whole portfolio is not going down. And then my other point would be have some cash available so that when we do have a correction, at that point you have funds that you can put back in the market. So those are great questions.
Yeah, and you touched on a little bit about the millennials and how their economy is different from them. You mentioned freelancers. I'm a freelancer. Some of the staff in the audience in the studio here also are. What are your suggestions, I guess, as how we can take advantage of the stock market, understanding that you said wages are not growing, that we're, you know, of the younger generation. I don't, you know, you said 401k. I don't think as a freelancer, you know, we're not. Our employer doesn't give it to us. You know, we have to do it kind of on our own.
That's a great question.
Any other advice on that?
Yeah, my advice.
As a freelancer, you also have the opportunity for personal SEP, which is so explain that. Even you might not have a 401k through your employer, But there are financial instruments that freelancers can also use.
If you know how to do it, though.
Absolutely, absolutely. So, for anybody listening to this program, one of the easiest things you can do is just open up a regular IRA. And depending upon your income, you'll be able to deduct that. But to Roland's point, a self-employed or a simplified employee pension plan, which is a SEP IRA, will allow you to contribute really up to, used to be 15%, depending upon what kind of plan you go into, almost 25%. But here's what I want to say to millennials, because I know that, one of the things we're spending a lot of time looking at in the financial literacy community is this income volatility, right? So, 1 month you may make a lot of money, the next month you may not, right? And so how do you deal with that? Well, you have to have adequate cash reserves, but the other point is don't make yourself feel like you need thousands of dollars to invest. Basically start an SEP IRA, start with putting $100, a month in, going in automatically. And then as you get to the end of the year or when you file your taxes, if you have some money in that cash reserve that you can now put in that plan, at that point put it in. But the key, I can't say this enough, is really getting started.
And the Acorn app, I have it on my phone exactly, and it takes, rounds up, so if you have a charge, it puts pennies a week into the stock market, but it adds up over time.
Yeah, but the one point I want to make there as well is that we really have to get knowledgeable about how to invest. And so understanding how to analyze and research stocks, I'm thinking of Snapchat. Everybody thought, that's a great app, everybody's using it. At the end of the day, at the end of the day, and you look at their earnings.
Not going well.
Yeah, exactly. And so at the end of the day, a company has to make money. And so you need to be able to analyze and research a stock, and when is it the right time to buy?
All right. Where can folks get more information?
They can go to DeborahOwens.com, and we have a lot of seminars, free webinars that are coming up, Roland. So really go to my website.
Right.
Free.
I heard that one.
That works for millennials, right?
All you broke millennials. All right there.
Weekdays on TV One.
I will never lie to you.
Oh my God.
Roland Martin.
He doesn't want to talk to us. He wants to ignore us.
Uncensored.
Hell no. That ain't gonna cut it, boo.
Unapologetic.
No, that is fundamentally false. You are wrong.
Unfiltered.
He wants an America where we all look alike. He ain't talking about black people.
Unrelenting.
You better go work out, because you got a fight on your hands.
NewsOne Now with Roland Martin. Weekdays at 7 a.m. on TV One.